All right. Let's be honest here. No one is waking up excited. Hey, maybe other than us, because I think
Yep.
this is actually coming off like you just had an interview with a reporter from the Globe and Mail to talk about
Yep.
this very idea. So maybe we are excited to wake up and talk about emergency funds. Because it's not flashy, it's not the sexiest thing, but it is and it's not something you like brag about on your social media or even like friends. It's not like, hey
Yeah.
guys, guess what? I just fully optimized to tier 3 on my emergency fund. It's called a wealth reservoir. But here's the truth, like after years of working with Canadian business owners and Canadian families, professionals, your emergency fund is actually, in our opinion, the foundation of your a great healthy wealth building plan. It's actually the difference between, I think, reacting to problems as they come up versus responding to opportunity. That's a difference. Let me say that again, right? Like it's the difference between reacting to problems and responding to opportunities.
Hmm.
And when you think about that, stretch that out, take those ends of that reacting to problems, responding to opportunities. That's a continuum. Stretch it out along a number line. Now, every one of us lies along that continuum. And we have a tool like that helps us navigate along that continuum of responding to or reacting to problems and responding to opportunities. And today, in this episode, what we want to do is unpack that continuum and talk about how your emergency fund actually evolves along that continuum and where its uses are and where some of the structures and pieces should live, because it will change as you grow older, or not necessarily older, as you move and your net income or your net worth grows. And it should change, and it will. And you probably are reflecting back when you were younger and you were saying, yep, I didn't have one, or I didn't have an emergency fund, but now do I have one? And I think you do. It's just, where does it live and what are you using it for? So we're going to call that out here today.
Awesome. Awesome. Yeah. And really what we want to do is we want you to see that emergency fund as something that will evolve into a true wealth reservoir. Okay. And when we talk about a wealth reservoir, we're talking about a strategic, liquid, tax efficient asset that's going to protect your lifestyle, fuel any future opportunities, and ultimately support your legacy. So, our plan here, we've got three things we're going to try to cover. One is why Canadians desperately need emergency funds, and especially now in today's day and age. The second is how to evolve your liquidity through three stages. So we're going to talk about the stability phase, opportunity phase, and then finally developing into that wealth reservoir.
Mm-hmm.
And then the last one is how it fits into our Canadian Wealth Secrets wealth health framework and how you can build your own system over time so that you can end up with that wealth reservoir of your own.
All right. So let's get into it. Because when you think about it, like, I think there's data here that suggests that 1 in 4 Canadians can't handle. This is staggering, right? Like 1 in 4, because if you're listening to this, you're like, well, that's not me. But I mean, 1 in 4 Canadians can't handle a $500 emergency without borrowing that. And typically those 1 in 4 are probably borrowing it from their credit card. So, more than half of people say that an unexpected $1,000 expense would actually cause serious financial stress. With rising rates, inflation, housing costs that squeeze households right now harder than ever. So when you think about it, when we think about all those pieces, it's like, should I have an emergency fund? Like, if your answer is yes, but then people right away say like, well, do I want money sitting around there like doing nothing? Like is it sit in a cash account? Like, should I put that to money? And that's where this continuum will come into play, because some of us needed to sit there and be ready. Yep. And some of us can structure or develop some opportunities that we can make use of. And basically what we say is put two uses to the same dollar.
Yeah, for sure. And, we've heard a ton of people, we hear the advice, save X number of months of expenses, which is a good rule of thumb, but it doesn't necessarily consider your stage of wealth or income volatility. So what I want to sort of preface here, because I'm going to guess that, Jon, there's probably a handful of people listening to this episode. If we go back to the top of the episode where we talked about the 1 in 4 might need to borrow to cover an emergency of $500, or half of people over $1,000 and so forth. the reality is some of these people may have done this intentionally. Like, as long as you have enough equity in, say, a home where you could dip into that equity if an emergency were to happen and it wouldn't break apart your financial plan, this could work. So depending on whether it's cash or whether it's leverage, you get to decide that, but you want to make sure that you're at least able to cover yourself for a specific amount of time. So while there's no rule of thumb, right, depending on your job, that might make a difference in terms of how much you want to be able to cover, right?
I was just saying, I was like, as soon as you said job, I was thinking it was like as a steady, a teacher who had seniority, and you thought, well, like, there's very little volatility in my income. You're pretty much in as an Ontario teacher that you're going to see that paycheck as long as you keep showing up to work every day. You're going to see that paycheck. Therefore, it's like, do I really need an emergency fund at that point? Like, what is the world event that's going to happen? Like, even COVID didn't affect that for teachers, right? So it's like, do we really need that emergency fund? So the whole stability, the idea of like your volatility is directly related to your job. So if you have a government job like we did, for a long time, then maybe you have some other, say, basically guaranteed income coming in. You don't need to have the same liquidity as, let's say, a business owner who's, trying to, scrape by or make ends meet. Or even if your business is doing well, you still don't have that guaranteed income to show up every day.
Right. And I mean, even if, let's say, you are in a stable job, or maybe you're in a less stable, maybe you're a business owner where it is less stable, you might choose, instead of having that emergency fund, say, sitting in a money market account or in a checking account or in a GIC, you might take that extra money every month and you might actually put it down on your home because you have a readvanceable line of credit. And in your mind, that line of credit isn't there for just fun spending. It's actually there because that money represents the emergency fund that you've contributed to pay down more of your mortgage. Like that's a move you might make. But what we want to make sure people have is enough of that accessible liquid cash available to themselves, whether it's through cash or liquid investments or assets, or whether it's through leverage, and that leverage isn't going to completely derail your life or your lifestyle if an emergency were to rise. Let's say you've got, dual incomes in your household, and maybe they're stable, fairly stable. Maybe you're only considering about 3 months. And that could be through, again, leverage or cash. If you're single income or you have volatile income, you might want to start thinking about more like half a year. Or if you're running your own business, you might want to be thinking something even more long-term, because you also bring in things, not only business might be lower or slower, you don't know if maybe any sort of liability event might show up. You're taking on additional risk, and therefore keeping more money liquid or more leverage liquid for these types of events can be really important as well.
Right. I think the key here is that, at this, when you're thinking about your fund, is that it shouldn't necessarily be a fixed number. You want this to evolve. You want this to be really a liquid system that will evolve with your life. Don't think of it as a hard and fast rule. You want to think about this as evolving, and that's what we want to build into. So before we kind of get into the tiers of an emergency fund and how it will evolve into a healthy wealth reservoir for opportunity and your wealth planning, let's just unpack again what our wealth health framework really looks like. So this is the framework we help with our clients when we meet with our clients and talk about their next steps and what their wealth planning system is going to look like. We tackle and try to solve problems in these 4 areas. The first area is what we call our vision area, our freedom. And this is like when you think about what do you want your life to look like when you're retired, you've got to know, like, what are some of the numbers? What do I want that to look like? What are the expenses? Like, how much are the numbers there to help me guide my decision making? Because you need that kind of vision planning to be done. And so knowing what you want your life to look like now versus later, versus, say, your next stage, and also into your heirs, is an important planning stage. So we help our teams and our clients kind of think about what that looks like and help them develop that plan. The second component is really what we're unpacking here today, which is what we call the wealth reservoir, but it is a continuum, and it is, say, a 3-tier process. So we're going to unpack that today. But every healthy financial system has a wealth reservoir. The third component is optimizing. We talk about that a lot in other podcast episodes about tax planning, investing, corporate structure. So this is our optimizing stage, like making sure we're making the right strategic decisions with the structures we have in play. And then the fourth component every healthy financial system needs is a legacy planning. Like, what are we doing for estate planning? Are we making sure that we're protecting ourselves down the road and making decisions now that actually make it easier later on? And that's linked with all the other areas. It's definitely linked with your vision. It's definitely linked with your optimizing strategy area. And it's definitely linked with your wealth reservoir. So let's unpack where emergency funds fit, which is really in that phase two. The establishing your wealth reservoir, because it's about protection, but it's about flexibility, and that's what we want to unpack here. So there are 3 tiers of your emergency fund, and let's start, Kyle, with tier 1.
Yeah, for tier 1, this is the start. This is where it begins, and it's all about just building some stability, getting yourself on track, remembering simplicity beats everything. So your stability fund is going to protect you from unexpected car repairs, dental, or as I'm experiencing with my daughter, orthodontist, appointments that seem to never end here. I should have been an orthodontist. Job interruptions, home maintenance, anything like that. And this is going to live likely in something fairly straightforward. It's going to live in like a high interest savings account or a money market fund, cashable GICs. The goal here is going to be access, not performance. So while, it's never a bad move to try to optimize, right? Put it in something that's going to be liquid and it's going to give you the best return as possible. The reality is we're not talking about a huge amount of money necessarily, but you should start small and grow from there. So for those who have no cash on hand, you might be leaning on leverage, right? And leverage is okay, but if that emergency does happen, you have to also process what's that going to look like after I actually utilize those dollars for that emergency? Meaning, will I ever be able to get myself out of that hole? Like, that's going to be a really important piece here. So start small. You got to start with a milestone. We would say about $1,000. That's like a Dave Ramsey move, but you want to get to the next stage, which is a month of expenses. And then finally get yourself to at least 3 months of expenses so that you actually are building that stability fund that you'll need in order to move from, because remember, this is tier 1 of 3 tiers over your lifetime.
And it's never too early, right? Because I was helping my daughter who's 15, and her cell phone is her life right now. And the cell phone fell in the pool in the summertime and was like, I need a new phone, Dad. I'm like, well, let's talk about emergency funds. Let's talk about why we want to start building towards that, so that when you do have an emergency and your phone is now considered to you your emergency and you need to buy a new phone or fix your phone, you now can dip into that. Like, there's never too early to start the discussion about like how much is enough for that emergency fund. And I think she settled on at the time that $100 was enough in emergency fund, because $100 could probably fix her screen on her phone, or start acting towards like, could I buy a used phone with $100? Probably not right now, like a used phone, but at least it's a start to get going. But she is like, I need
a down payment on a new phone.
And guess where that lives? It lives right now. Like, we use YNAB here in our family, which is You Need a Budget, which is an app we put on our phones, and everyone has their app and everyone can track, like the money in your account. But then it's like, well, I put it into buckets, and we've got a bucket, assigned to emergency fund. So that's living in her cash account, right? That's in her checking account that's just sitting there, which is because it's liquid. When that phone breaks next time, because for some reason teenagers can't stop their phones from cracking. But the idea here, right? Like, the idea of this stage here in this tier is that, here's your mindset shift, is like, the fund buys you time, it buys you space, it buys you clarity. It's not going to give you the returns. It's just there just in case, which is what, when you say emergency fund, this is what we're talking about. Like, this is what most people think about when we talk emergency funds. It's tier 1.
Yeah. And, the key here with an emergency fund, like, I think why so few people actually spend enough time or effort thinking about building an emergency fund is, again, we said it at the top of the episode, it's not very exciting, right? Like, and you think like, well, then what, right? Is that money just going to forever sit there? And no, in our world, what we actually encourage you to start thinking about is like, when you accomplish that tier 1, the stability fund, you actually are now opening the door to now looking at it as an opportunity fund. So at some point, if we continue to build that emergency fund, but we actually don't set a ceiling on it, like we actually continue to do the same actions week after week or month after month and building that fund, it will eventually morph into an opportunity fund. So this is where we're like actually going to start managing that liquidity like a pro. So you've now earned the right to actually start thinking about your emergency fund and potentially start blending things a little bit. So what we typically see people starting to do, and we experience this in our journey, in our wealth building journey, is that we actually transition from, continuing to just stockpile cash over time, but then we started to look at our home value or our home mortgage had actually started to be decreasing over time as well. And that introduced the opportunity for a home equity line of credit, which we could also lean on should we have any sort of emergency, or this is that transformational portion of the phase where we can now look at that home equity line as a potential opportunity fund as well.
Well, here's the nice thing about the home equity line of credit, because so let's say you've been building your cash account for your emergency. Let's say you were, building it up to have 6 months, 3 months of emergency fund. When you start to look at your home equity line of credit in terms of not a debt equity sitting in my home, I actually could put it to use. It becomes like your shock absorber, which now means like you can reallocate the dollars, because you now are like allocating this money that you're like, okay, if an emergency happens, I will lean and go and borrow money so that I can pay that emergency off. I'll make sure I can replenish that. But now what you're going to do is it frees up your cash that you were contributing to your emergency fund to now act as your opportunity or your investment fund. Now you can start generating more net worth because you're not holding onto that money now. That money is now getting put to use. So now it's like, now I'm stuffing my RSPs at a higher rate. I'm making sure I'm maxing out my tax-free savings account. I'm investing in these non-registered types of accounts. This is where our life starts to shift, to start really compounding. And it's because you now realize or gained access to leverage, or had opportunities sitting there ready to go when the time is right. And I think that's the biggest advantage of the opportunity fund when you get to this stage, is because now you've got this ability to start compounding your efforts when you couldn't do that before.
Right. So the mindset shift that we're actually seeing happen here at this portion or this stage, tier 2, is that you're moving from protection only to actually moving towards flexibility and efficiency. And that original, again, tier 1 is helping you to give you the confidence that you're going to be okay, and that, hey, hopefully no emergencies happen. Hopefully we get out of, that stage without anything significant taking place. And now we can start thinking about how do we actually grow our net worth and how do we invest. And when we get to this place and we start to build up our net worth and we start to build our investments, we now start looking around, and actually you almost end up here without realizing it, that all of a sudden you're in tier 3, and that's the wealth reservoir. This is where your liquidity actually becomes more strategy. Okay. So this is where high net worth Canadians start to gain a massive advantage. Once your net worth hits mid to high 6 figures and beyond, cash sitting at a bank becomes inefficient. And you start to recognize that, there's other things we could be doing with this money. And you also know, based on whether it's leverage or other liquid assets, that you're going to be okay if you bump into some of these emergencies that we were trying to protect against in the earlier tiers. So now we want to actually design our liquidity to grow. We want to think about how do we make it compound? How do we make it be tax efficient? And then how do we actually help us down the road to support our retirement goals as well as our legacy? And this is what we call the true wealth reservoir. So the tool that we use is high early cash value for this particular stage. Again, not suggesting that you jump over those other 2 tiers. Like, you need to work your way up to this place, but we want to make sure that high early cash value participating whole life insurance starts to take those dollars from sitting there and essentially doing little to nothing, and we start compounding at a better rate. Now, remember, this is still going to act as an opportunity fund for us, but it can also act as that emergency fund. So we have something where these
Right.
capital is safe and stable. Your cash value is going to grow every year. It's going to be guaranteed to not go down. It behaves like a tax efficient GIC, and there's a massive long-term upside in making sure that it takes care of our estate needs as well.
Mhm. Yeah. It's also accessible. Like you can, and this is the growth part, right? Is like you can borrow most times, depending on the lender, up to 90% of the cash value. If you're going with a policy loan, you don't need any bank approval. You just say, "Hey, I need that money now," and they lend that back to you. You can go with a third party, and maybe you can get 100% of that cash value loan back to you, so that you can now have the true opportunity fund. So maybe that money's working and growing on the sidelines, but also I could have access to it. Like your home equity line of credit, in a way, does this because technically your home grows, hopefully, over year to year, but your participating whole life insurance is guaranteed to grow. And guaranteed to grow year to year, because the cash value is guaranteed to get up to the value on the policy value by death. So that's an important distinction right there, that you can use it for safety, but you also get to use it for growth. It's tax sheltered. The death benefit pays out tax free. If you have it owned by a corporation, it's going to go out to the capital dividend account to the shareholders completely tax free. As we said before, it complements your portfolio. It becomes that low volatility base that supports your stocks, your real estate, your business holdings. Like it becomes that liquid or that fixed income portion of your portfolio. It can grow that way, freeing you up to use other portions of the same reservoir to invest in more growth assets. So the mindset shift here is that liquidity is not just protection, right? So it's like before it was like, I got my home equity line of credit in tier 2 just in case, but I can, if an opportunity does come up, I have some funds. Now you're being more strategic. It's strategic compounding, and we want to do that well. And that's why we said before, this is what separates high net worth individuals and specifically corporate business owners from the rest of the herd.
I love it. I love it. So let's talk a little bit about how the tiers work together. Quick little recap here. So there are 3 tiers. That first tier, again, it's all about stability. We call it the stability fund, and the purpose is protection. Where it's going to live is going to be somewhere very, very basic. It's going to be either cash in a cash account. It could be in an envelope in the cupboard. I would suggest, probably getting it into an account and get it earning something, high interest savings account, money markets, maybe cashable GICs. And the real benefit here is access, peace of mind, and really to get you to take the step in the right direction so you can move into the second tier. That second tier is the opportunity fund. Now, our emergency fund morphs over time. Now we're less concerned about protection. We're not going to ignore protection, and we're more concerned about flexibility. This is where we might start deploying some of that cash that we had on hand, and we might use something like a home equity line of credit to make up for a little bit of that just in case money. And this is going to start keeping more capital productive. And then finally, over time, as we continue to build those and take those opportunities and start building up our net worth, we're now going to see it emerge into a wealth reservoir. And that reservoir is it's like the place we want all of that safe money to come back to. I might send it out into an investment, but when that investment comes out, especially if maybe it's a 5-year private equity deal, or if it's private lending, or if it's even real estate and we're cash flowing, I want those dollars to come back to my wealth reservoir so that I'm ready to go and be strategic for the next positioning that I want to take. Where we typically see that living and where it can be most efficient is going to be in a lifelong participating whole life insurance policy. That's properly structured, of course, because of all the additional benefits that are going to help us down the road. Because remember, with investment strategy comes more tax problem, right? Good problems to have. If I have a lot of capital gains being, growing in the background and they haven't crystallized because I own assets, at some point when I pass or when I sell, there will be capital gains to pay. And that's where now our wealth reservoir gets to actually act and help to protect against all of those dollars going out the window. So the key benefit here is not only going to be maintaining liquidity, it's not only going to be to help us continue growing our assets, but it's actually going to make sure that our legacy is solidified over time. So the key piece here is that the cash is going to build stability, liquidity is going to build opportunity, and then finally, the structure that we utilize is going to build legacy. And we want to make sure that we're doing all of those things in the proper order so that we can truly build a legacy that lasts.
Yeah, and that's one of the guidelines is don't skip the tiers. A wealth reservoir only works when it's built on top of tier 1 and tier 2, and you've got your mind thinking about the way that you want to structure this. So that's one of the guidelines. Another guideline is, especially if you're getting started, like automate your savings. Like if you're like my daughter, like put that into the account regularly. Like let's start building, like make it a habit, right? So get the momentum going. The other guideline that we would recommend is review periodically, like review annually. Maybe it's quarterly, maybe it's semi-annually, but it's like as your net worth grows, your liquidity strategy is going to evolve with it. So you continually reflect on it and then think about the tools. It's almost like, where is my opportunity fund right now if I'm in the opportunity tier, and what's the structure that I'm holding that for? Like if it was me, I've got that all outlined, and me being a geek, and I got spreadsheets that show all these funds and all these buckets and where all this money goes. It's like, do we have that laid out? And that's sometimes what is beneficial when you start to review. It's like when you wonder, you should go, I know where the answer is to that. The final, I think, guideline we have here is if you're using your opportunity fund or your wealth reservoir the way it's intended, is set the borrowing rules. Like Kyle said, it's like, the money's going to come out, you're going to borrow against it, but you've got to plan to pay that back. Like pay that back so you can replenish your fund. You can replenish your reservoir to continually build and strengthen. You got to do that with discipline. You got to figure out, what is that plan? Like, is the plan that, I'm going to go and use this as a down payment on a real estate property, and then the cash flow, because I've done the analysis, the cash flow coming back is actually going to start to slowly replenish that fund. So it pays down the interest, but it also pays down a little bit of the principal as well. So over time, it's all of a sudden now you own a property completely outright. So, or when refinancing comes, maybe that's your plan. Refinance, take that refinancing, take the equity, plop it down, boom. You've replenished your opportunity fund for the next tier. So treat it with discipline. Remember, your emergency fund shouldn't just wait for bad news. It's not there for bad news. It should be ready for good news too, and ready for those opportunities to pounce on.
I love that. And I want to almost say it in a slightly different way as well, just to kind of, get people thinking, is like, when we think about emergency fund, you feel like it's taking away from your future building of net worth and building of assets, when in reality, it's actually a part of the journey. Right. So look at that emergency fund as like, it's not only going to help you deal with the short-term bad, but by building it effectively, it'll actually help you get closer to those investments and those assets a whole lot sooner. So look at it as a process, not as a thing that you need to check off before moving on to investing. It's actually the very first step, the very first phase. So make sure that you're thinking about it that way, because again, it's the most important as you build your net worth, but also as you start thinking about your estate as well. So just keep in mind that this wealth reservoir that we're building doesn't just help you today. It actually helps to become one of your most important estate planning tools. So not only is it going to help you offset capital gains at death, that's a massive benefit. Not only is it going to provide you tax-free liquidity to your estate, but it's also going to make sure that you preserve the real estate or other investments that you've created, that you've invested in for your heirs. So create that multi-generational pool of family capital by working yourself through the tiers so that you can get yourself to a true wealth reservoir. And ultimately, it really is the ultimate transformation. In stage 1, it's going to protect you. Stage 2, it's going to empower you. Stage 3, we're going to keep compounding, and it's going to compound for you. And finally, by stage 4, it's actually going to outlive you. And that's the magic of strategic liquidity, like we've been talking about here today.
I guess that's tier 4, is it outlives you. So if you're ready to transition from a basic emergency fund to a true wealth reservoir, here are a few next steps. 1, take our wealth health assessment. It's actually going to show you exactly where your liquidity system may be weak or underutilized. We're gonna assess. Maybe the wealth reservoir area is where you need the most work, or maybe it's vision right now, or maybe it's strategizing. Take that assessment. You can do that over at CanadianWealthSecrets.com/pathways. If you also are a Canadian business owner or incorporated business owner, check out our free masterclass on building tax-efficient retained earnings and how to use those to your advantage. You can head on over for free over to CanadianWealthSecrets.com/masterclass. And just as a reminder, the content you heard here today is for informational purposes only. You should not construe any information as legal, tax, investment, or financial advice. And Kyle Pierce is a licensed life and accident and sickness insurance agent and the president of corporate wealth management here at Canadian Wealth Secrets.